Good morning, everybody. It's Greg Harrelson here with Century 21, the Harrelson Group, and of course, somebody that you're familiar with, Abe Safa, also with Century 21, the Harrelson Group. And here we are with another episode of Myrtle Beach Real Estate TV, where we continue to bring you the latest update as to what's going on in the local real estate market. Of course, we give you ideas on what we're hearing in our communication with buyers, sellers, other agents, bankers, mortgage people, etc., as well as the latest data to share with you the trends of the market. Abe, thank you for joining me again. It's been a solid month so far. July was great. Anything interesting that you see with the real estate market right now before we get into numbers?
Yeah, I'm definitely starting to see a lot more conversations in the media about the market softening up a little bit. Some headlines are really catching people's attention, like the housing boom is over and things like that. So I'm definitely starting to see more of that, as I'm sure you are.
I am seeing a lot of that. What's interesting is, I'm always, and I think you probably agree to this, is one of the reasons why you and I look at the local data as much as we do is that's a way for us to kind of weed through maybe headlines that are built to just get attention, to get clicks, to get viewership and whatnot. Because it's like the headlines when we look at the news, it's like, is the real estate bubble about ready to burst? And it's like, okay, really, like, I personally don't think that there's any data anywhere in any market in our United States where it would show that there's a bubble about ready to burst. I mean, there could be. I mean, there could be an anomaly somewhere. So, we know that a lot of times those headlines are created just to attract attention. It's to sensationalize, to kind of like strike fear so people will tune in. I am seeing more and more of that. So I try to weed through, like, is this a real headline or is this clickbait? Let me look at the numbers to see if there's anything good I can extract from that. But we really rely on the local news much more. But I like you, am seeing it quite often. And some of the headlines are quite aggressive. And I'm like, this is kind of like, what is this? But I think news is kind of like that. And I think it's one of the reasons why we're motivated to do Myrtle Beach Real Estate TV is we want to kind of leave a lot of that stuff to the mainstream news and let's give you real localized news.
Yeah, there's no question. So I'm with you. I don't agree that with what's going on out there as far as the market's about to bust or there's a bubble about to burst. I don't believe in that. But what's interesting, and the reason I pay attention to these articles is the conversation with, we talk to a lot of people out of town that have homes here, second homes, vacations, condos, things like that. The conversation with them, I'm getting more and more people starting to tell me, hey, the market is softening. So people around the country, now it's getting to the consumer that the market is softening. So I find that interesting because I think that's going to be the beginning of inventory starting to grow. Mm-hmm. As sellers, as owners start to feel that and really believe that, then we're going to see more people don't want to miss out on this opportunity that we're seeing.
Yeah, I agree. And, I guess, some places where that's showing up, I have received more calls and more emails in the last couple of weeks from property owners that I've been, just keeping posted as to what's going on in their communities, just giving them a nice newsletter every month. And they're starting to kind of reach out and just say, hey, what do you think the market is? The market kind of at the top? What do you think the market's going to do next year? I don't necessarily get the direct question, do you think the market's going to go down? I kind of, that question is more formatted like, hey, what do you think the market's going to do in the next year? But I kind of know that what they're asking is, do you think the market's going to go down next year? And I've seen a few more people decide, hey, look, I was going to sell next year, but I think I'm going to just go ahead and do it now. And this is slight. These are just the reason why, like, I noticed this is because I haven't heard this for the last year.
Right.
So it's not that like everyone's rushing to the market. It's just we're starting to see that first wave of people that are starting to talk about this. and usually comes another wave and another wave, and then the market, could soften. And it's likely to soften at some level. It's just unlikely to crash, at least anywhere in the near term. But that's one thing that I'm noticing that's a little bit different. And then something I think we both touched on in previous weeks is the number of times that we're receiving multiple offers on our listings is decreasing. It's still happening. And there's certain pockets where it's going to happen more so than others. And then there's other pockets that it was happening that's not happening at all. So again, these are all subtle shifts that we're noticing that's taking place. But besides that, I'm sure the numbers are going to look pretty strong based on what a normal market is. I would say we're still in a hot market and probably still favoring the sellers in this hot market. But why don't you go ahead and open up the data and let's see what the numbers say.
Yeah, what I'd like to do is this week share market stats, because we just completed a month in September. So I usually give it about 7 or 8 days into the new month. So for the numbers to finally add up and then look at this. So what's interesting is that, if you just took a snapshot of what is currently happening right now in the market, it looks like an extremely strong market. It looks like it's on fire. So let me kind of explain what I'm talking about. So this right here is single family homes that are previously owned. That's what we really focus most of our attention on. If you look at the month supply, we're sitting at a 1.2 month supply. That's down almost 66% from last year at this time. So when you look at that, it's an insane number to get your head around, but that's an extremely low inventory number. All right, so that's an extreme market. Again, a neutral market is somewhere around a 6-month supply. That's neither a buyer's market nor a seller's market. And you see the last time we were there was back in June of 2017, and it kind of just hovered around the 5 for a long time. And then in this past year, 14 months, it just completely just got obliterated. All the inventory was lost. So when you look at that, it's an extremely strong number, Greg. But you and I have been talking for a couple of months, like, hey, we're starting to see some changes. Something is happening here. And I want to just point out something here real quick. So you can see when I hover over this, right? I see it on my screen. Okay.
I see the bubble, the box.
Yeah, so
I have to put my glasses on.
Right now, we're at 1.2 month supply of inventory. Okay, look at last month. So that was the end of June. End of June was a 1.2 month supply of inventory. End of May was a 1.1 month supply of inventory. End of April was a 1.1 month supply of inventory. And then if we go back to March, it was 1.3. So really April, at the end of April is when it bottomed out. And then since the end of April, it's kind of been flat.
Yes.
Now, some can argue, well, look, how much lower can it possibly get? I mean, there's not a whole lot of inventory out there. There's only a 1 month supply of inventory. But just the fact that it's kind of flattened out, went up a little bit, down a little bit, just kind of flattened for 4 months now, it to me is a clear indicator that, look, things are starting to change a little bit. Again, I don't want to cause panic or anything. We're still in an extreme seller's market. Sellers still have a lot of leverage. But like you said earlier, we're not getting 6, 7, 8 offers on a home in the first 5 minutes it hits the market, right? It takes a little bit longer, but stuff is still selling. But this is the beginning of a little bit of a change, a little bit of softening, I like to call it, in the market with single family homes.
Yeah, and personally, all of this is a snapshot in time, right? Like, and that's what you're doing here. When you just walked us through those different months, you're giving us a snapshot for each month. And next month, there'll be a different snapshot. Probably won't look too much different than what we're seeing right now. But the reason why we say that is, when I look at this snapshot in time where we currently are, I'm kind of happy to see inventory go up a little bit. Like, let's just say that inventory went down to 0. There's no inventory now, or there's only a half of a month, 15 days of inventory. Some sellers might say, well, yeah, but prices would really skyrocket. Okay, I got that. But in the big global picture across the country, then the number of sales would be so low, because if there wouldn't be a lot of sales, and that would mean there would be a lot of people out of work.
Right.
And so we need sales to fuel the economy. Not that real estate is the only thing that fuels the economy, but it's very significant to the economy. So if inventory got too low and there was no inventory for the buyers, then that means buyers wouldn't be buying and they wouldn't be selling their property in New Jersey or wherever they're coming from. And so there would be jobs lost here, there would be jobs lost there. All of that stuff would come out of the economy. So I always look at it and say, you know what? Maybe we don't necessarily want to have 6 months of inventory. I'd love to see 3 months of inventory. I think that would be a really nice, stable market. So when I see the inventory going up a little bit, I'm not panicking. And that's why we keep saying that. Like, we're not trying to say panic. As a matter of fact, it might be good for the economy for us to have a little bit more turnover and more transactions like this. So, I just wanted to add those 2 cents into it.
Yeah, no question. I'm on the same page. That's a great point. Because like right now, look at closed sales for the month of July. So it was down 10.5% from last July.
Mm-hmm.
And I think that's strictly a function of there's just no homes out there like there was in last July. So when inventory does get that low, all of a sudden, homes aren't turning over, attorneys aren't getting their income off of that. You got appraisers, you got inspectors. There's just so much involved. Real estate is a huge integral part of the overall economy. So I do agree with you that, being at this level is not healthy for the economy.
Yeah, we have buyers, right? So like, I think what you're saying with that last chart in July, that, the number of sales are down 10% for that month over month or year over year during that 1 month. But we don't necessarily believe that's because there's not a bunch of buyers that are wanting to buy. We believe that it's because there's buyers sitting on the sidelines waiting for something to come onto the market. It's more that than anything else.
Yeah, I agree. That's
and one thing that has, like, if you take just a year ago, our average sales price was much lower than it is today. The average, you got that?
Up 21% from last July.
Okay, so you got to think about it. A lot of the buyers that we're dealing with, their income and their financial, their net worth and their income didn't necessarily increase by 21%.
Right.
So some of the challenges that we're having is there's less properties coming on the market, but all the properties that are in that affordability range are scooped up so fast. There's none of them on the market. And a lot of the houses that were affordable have now appreciated and are no longer affordable. So we've lost the affordable inventory because of appreciation and because of the demand. So it's kind of like a double whammy.
Right.
And so there's plenty of buyers. As a matter of fact, what we're having to deal with as real estate agents is when we get buyers to ask us about these properties and find them something in a certain price range, let's say $295,000 or $300,000. The challenge we have is to educate them and explain to them what the inventory situation is without discouraging them, because they're ready to buy today, but there might not be any inventory on today. So those are adjustments that we have to make in our communication with our leads.
Absolutely. And on the topic of having a bust or the bubble burst, let me just kind of show you something here. So this is when we had the last bubble burst, right? So we went back at the peak of the market. We were as low as single family homes. We were as low as 2 months supply of inventory. We're actually lower in inventory right now than we were. But when the market crashed, look at what the inventory went to: 21 months supply of inventory. So anybody out there talking about, oh, we're going to see another crash, to go from 1.2 to 21 months again is that's just so far out. Unless, again, something drastic happens. We obviously can't control every single variable, but I just don't see a crash.
Yeah,
I do see a correction. I just don't see a crash.
Yeah, and then remember, we've kind of touched on this before, that when we saw that bubble burst, a lot of that was because people were so over leveraged. I mean, what people were doing, I mean, gosh, do you remember? Oh, you weren't, I don't think you weren't selling that year, but Abe, what happened was interesting. Is we had people coming in buying multiple properties sight unseen. They would come in and they would be an investor that was buying residential homes. A new construction community would open up and they'd go buy 3 homes, new construction. with the plan on, they're going to flip them. Okay. So they never planned on owning or living in the property. They never planned on paying one mortgage payment. They planned on, as soon as they closed, they were going to flip it. Okay. Maybe they pay one mortgage payment. Then the real estate market started drying up. That inventory started drying up. So then those investors that were used to buying houses, they went in and bought, well, let me go get 3 condos. The banks were giving out money so easily, so they leveraged them. They got 100% financing. It's called a HELOC. They'd get an 80% loan from one company and a 20% loan from another company, finance it at 100%, buy 3 of them, fully leveraged. Then all of a sudden they couldn't buy condos. There was no more condos. So guess what they were doing? They were going to communities like the Bluffs in Carolina Forest that had no homes. They were just selling lots. And they were buying 3, 4, 5, 6 lots, or like Waterway Palms Plantation. They were buying lots. They'd buy 5 lots at, $45,000 to $50,000 a piece. No plan on ever building one of them. So all these people had multiple properties that they never planned on using. They all had a strategy to dump them back on the market. Mm-hmm. So when they started feeling, oh gosh, we might be at the top of the market, then everyone started dumping. So one person would say, oh, I want to list all 3. I want to list all 5. I want to list all 4. That flooded the market so fast. One of the reasons Abe and I say that we probably won't have that type of repeat is because, number one, people have a lot more equity in their property. They're not as leveraged as they were back then. And number 2, most of our buyers are not buying for speculation. They're actually buying for real usage. So, and they're not buying 3. So if the market shifts, they won't dump 3 properties on the market. They may dump 1 property on the market, or because they're using it, they may not sell it at all. So we shouldn't see a quick spike to 21 months of supply unless something occurs that we cannot see at this moment. We should not see that.
Yeah, that was a great way to explain it. Yeah, I absolutely agree. Days on the market down 34%. We're sitting at 54 days on the market right now, median days on the market for single family homes. And the interesting thing is condos all of a sudden have really also taken off in the last couple of months. Yeah. Condo inventory is down to a 1-month supply. So that's down 80% from last year at this time. 80%, which is insane. So there's only 1/5 of the number of condos as there was last year at this time. And you see that's kind of been declining, every month, as opposed to the last 4 months when the homes kind of flattened out. The condos have still been declining. And now this might be the bottom. I don't know how it can get lower than a 1-month supply. I mean, it is possible. Back in 2006, it was a 1.6. So we're even lower than then right now at a 1-month supply.
Yeah. And there might be some seasonality into that, right? There, so it'll be interesting to see once the rental season is over and people are back into school, and we'll see if that slows down a little bit. I am starting to hear from some agents around our market that their number of pendings that they have under contract are kind of decreasing a little bit. Mm-hmm. So if somebody's pendings are decreasing, then that means in around 30 to 45 days, you would see their sales decreasing. So I think the October will be an interesting time to start looking at the condo market.
Absolutely. And this is a breath of fresh air here. Like if you look at the average sales price for condos, up 18% over last year. Because I know there's a lot of people out there, the people that you're talking about that bought multiple condos back in the heyday has just been waiting for some sort of break where they can actually get out of these units. So we've seen an 18% appreciation since last year.
Can you put up a chart on the same chart, but for residential?
Uh-huh. This is average sales price residential.
Yeah. Yeah. And then put the condo chart again. Notice how the curve on the condo chart from, say, when it was at its peak to going down to going up. Notice how long in this little chart, how long it stayed flat and how modest the increase is.
Right.
And then if you go look at the residential, you see, okay, it curved down and up, and it was up sharper. This has a lot to do with go ahead.
I'm going to change it to a 5-year view because that was about a 15-year view. So this is a 5-year view, what it looks like. So this is a single family home, average sales price. And then when you look at condos, you see, this is what you're talking about, how flatter it is. And then all of a sudden from here, which was June of last year, it started going up.
Mm-hmm. Yeah. And so one of the things that I was going to mention is, that would be fairly common because condos are more of an investor, speculative, or a vacation type of property. And residentials, the residential homes don't turn over as much as the condos do. And so because of that, you're going to see that the residential properties usually are going to rebound. They're going to stay flat less and rebound faster. Condos are rebounding very well right now. It's just it took longer for the condo market to rebound than it did the residential market. And that's going to be very common. It's going to be very common. You'll see that historically just because of the usage of the actual real estate itself.
Yeah, Nicole Murrin just mentioned that condos are the new first-time buyer option. That's an interesting point. Yeah,
that 100, especially when we look at condos off the oceanfront, like condos, because a lot of when we use the word townhome, usually people will look at a property that has 2 stories and say that's a townhome. But a lot of these, what looks to be a townhome is really classified as a condo if we talk about legal classification. So when we get off the oceanfront and we start looking at the condos in other communities, non-oceanfront, there's no doubt that many of them have been the alternative for buyers over residential first-time homes. They got priced out of the residential homes and pushed into the condo market. Great observation.
Yeah, no question about that. That is a great observation. If we can actually break this down into oceanfront and non-oceanfront, which the system does not allow us to, you'll see that a lot of this appreciation is off the oceanfront.
Yes. Yeah, the bulk of the appreciation is off the oceanfront. The oceanfront. And if somebody was to say, well, what is your theory on that? The oceanfront, a lot of times people scrutinize the rental numbers and the net income off of the investment. And what we see is that the net income is off of the rentals is not necessarily increasing. So therefore, people are not jumping to pay more. Because if they're going to pay $200,000 and the property's already breaking even, then $250,000 for that same property means that property's now at a loss. And so there's a limit to how much they're willing to lose on an annualized basis to own the condo. So there's a little bit more analysis that the buyer puts into play when making those decisions versus the off the ocean. A lot of times they're not using financials as a justification to purchase or not purchase. There's different motivations for making that purchase. And so that's where you're going to see the prices have a little bit more of a upside to them.
Right. That's all the numbers, Greg.
Okay. Well, hey, that's excellent as usual. I appreciate you doing that research for us. If there's anything we can do for you, again, I'm Greg Harrelson, Century 21, the Harrelson Group. Abe Safa, Century 21, the Harrelson Group. Here's our cell numbers. Feel free to text us, call us. You could find us, on all over the internet. So you can find us on social media, Facebook and whatnot. You could private message us. If there's anything we can do for you, we sure would love to earn your business. I'll see you next week on another episode.
Thank you all for watching.